All right, so let's pick up with 3.2, talking about the business cycle. In this section, we want to explain how individuals and the government influence the economy and the 4 stages of the business cycle. So terms we are going to look at here, just a handful: the business cycle, prosperity, recession, depression, and recovery. The United States economy is a mix of public and private forces. So you have the government, which is your public, and then the private, which is citizens and businesses. Individuals have enormous role on the market for goods and services. Whether or not we are employed and have money to spend helps drive the production of these goods and services. The Congress and the President can enact laws that help impact financial policy. And then the Federal Reserve, which we generally refer to as just the Fed, is a government agency that guides the economy by regulating the amount of money circulated, controlling interest rates, and also controlling the amount of money loaned through the banks. In the 4 stages of the economy, I don't know where our chart went. There was a lovely chart here, so let's pretend it's there. I will show you in class the chart in the textbook on page 44. But let's move on. Prosperity is like the height of the business cycle. Unemployment is low, people are employed for the most part. I mean, you might still have some unemployment, but it's low in comparison to the other times in the cycle. There's high production of goods and services because there's high demand for the goods and services. New businesses are opening. Prosperity is high. You know, people are feeling good, they're spending their money, the economy is going. In the business cycle, this is more frequently known as the peak. So when you think of a curve going up and down, this is the top point of that. The recession. Economic activity is slowing down. So demand is not there as much for goods and services, so businesses start to produce less, which then means they need fewer workers. With fewer workers out of job, you start to see the unemployment rate rising, and because they're not working, you have less consumer spending, which then means because we're spending less, we're not producing as much, and so our GDP is going to lower. This is commonly known as the ripple effect because as it happens in one industry, that could lead to a recession in another industry. So for example, if we have a recession in the automaking industry, people are not wanting to buy entire parts of cars or entire cars, then the businesses that supply auto parts, those are going to have a recession as well. So it starts to impact other activities and trickle down from there. Now if it gets really bad, then you have what is called the depression, or a depression. If you have a depression, unemployment rate is very, very high. So a lot of people are out of work. And then that leads to low production of goods and services. Not enough demand to produce the goods and services, which then ripples down into that unemployment rate. So everything's circling together. A deep recession will affect the entire economy, not necessarily just one industry, but the entire economy. And a depression in one country can spread to other countries' economies as well. We saw this in Europe in the past 5 or 10 years, where the EU, certain things are happening in countries like Greece and Ireland, and then that's leading to recession and depressions in other neighboring countries as well. For the United States, a depression has been very, very rare. Probably the most famous example of a depression is the Great Depression. On October 29th, 1929, Black Tuesday, as it's commonly known, the stock market fell dramatically. And between 1929 and 1933, the GDP fell 50%. Over 50%, in fact, I think. We were producing less than half of what we had been prior to 1929. And at the time, the United States did not have any sort of federal insurance on banks. And so banks were failing because depositors were not protected by their money was not being protected. So depositors were running to the bank, sometimes literally, and pulling out all of their money, which then meant the banks didn't have the money to be able to trade and offer loans and get interest rates and stuff like that. So with banks running out of money, many of them closed and pretty much permanently. Great Depression for a reason. Recovery, fortunately, after a depression and a recession as well, if it doesn't get as bad as the depression, you have a recovery. So you start to see that business activity is increasing. So there's production that's happening, and if more production is happening, then jobs are increasing, and if jobs are increasing, that means there are people who have money to go out and purchase goods and services. And so this time, it's positively impacting each other. Production stimulates the GDP to rise. I'm not sure why I have that awkward phrasing there, but production stimulates the GDP to rise. And then this leads us back to prosperity. So now we have gone through our curve, from the bottom, now we're rising up and getting back to prosperity. So during our recovery, some businesses innovate and create new goods, new services. So you see things that are helping try and spark the economy by sparking new interest and new demand for new goods and services. All right, here's the graph I wanted to show you earlier. And you'll see that on the left-hand side, it starts off at the peak, which we knew as prosperity. And as things, as the business activity starts to slow down, we have the recession. And we get to the bottom, it's called the trough. And the bottom doesn't necessarily indicate a depression, it just indicates this is the worst it got in this particular cycle. And then we start to expand and go into that recovery period until we get to kind of a peak again, a peak of our prosperity, and cycle back forth. Now, again, over long term, you're going to see generally a positive growth trend in the United States. So we go through ups and downs, but in the long term, it tends to positively grow. That's why when we tell people who are investing, think long term. Right now, you may be, having some risks with your stocks and stuff, but if you think long term, what's going to happen? Ideally, those companies will still be around for you to benefit from your investment. All right, and that is a short synopsis of the business cycle.